Monday, we closed up 414 points on the Dow Jones, and the S&P 500 is now over 4,100. A lot of really good numbers this past week.
Yeah, broad-based rally across all of the equity market indices, including some of the smaller cap stocks which led the week, but also within the fixed income space, credit was strong to end the week with high yields credit spreads coming in, and that effectively means that bond prices went up.
Yeah, that's right. And of course, when the NASDAQ goes up as much as it has, which has been 20% for the year, which seems shocking, the S&P 500 over 7% for the year. And then you talk about what's happening with the Treasury market. That obviously is what's happening with the Federal Reserve, certainly signaling that what's called the terminal rate, where they're going to stop raising rates, is near there. In fact, the market is suggesting that we may be at that terminal rate now.
The terminal rate is probably going to be at around 5%, and that's effectively where we are at the moment. And as our CIO, Derek Felsky, has said, once you start to get towards that pause in rate hikes, you do tend to have a resumption in the equity market going higher. So that does tend to be a catalyst.
It's funny. The other thing that Derek brought up is that we may be in the eye of the storm. Explain what he means by that.
Well, when you think about a hurricane, you have that first headwind or storm disruption. That's effectively landfall. And from the market's perspective, that was the dramatic increase in the Fed funds rate that occurred in the last year. Now that we're in the eye of the storm, it's more of a wait and see. Hey, maybe the economy is going to be able to deal with what's happening. We aren't seeing earnings collapsing. There's money on the sidelines. Maybe markets can go higher, and maybe the economy can chug along.
And of course, that also means that the other half of the hurricane could be coming, which means that we could get a retest. And there's a lot of conversation about that right now. When we mean retest, the S&P 500 was around 35 or 3,600. We're now at 4,100. When people say retest, at least market technicians, that means it's going to go and retag that again before moving forward. There is some theory to that.
Yeah, and that would be consistent with what Derek had said in the past, the second landfall of the hurricane. And that's caused by, the economy decelerating into the back half of the year as monetary policy acts with that long and variable lag, meaning that maybe the economy starts to weaken.
Yeah, and let's talk about that. So, monetary policy has a lag. And so all of these rate raises that the Federal Reserve has done, as we well know, 7 of them last year, 2 this year. So that is significant. And of course, that has a lagging effect because now the higher interest rates finally get into the economy, slows buying down. And that is the definition of a slowing economy. Here is the concern that, of course, we may not see that until the back half of this year, and that is another reason why we're concerned about what it's going to look like on the back half of 23 or early 24. And we talk about the back half of the hurricane, there are things that we have to be careful of. Banks would be one of them.
The Fed, the FDIC, and the Treasury did a great job effectively backstopping the banking crisis. But what they didn't do is change the opportunity cost in the market. And Annex, as fiduciaries, we've been out there pounding the pavement saying, if you have excess money earning nothing on your deposits, put that into short-term treasuries, put that into money market mutual funds where you can get a yield now approximating 5%. Well, these same regional and community banks, they can't hike up their deposit rates because they're sitting on loan and security books that are yielding maybe 2 to 3%. So if they try to compete, they are operating at a loss.